Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Yeah, good morning. Today we're cutting through the noise, sifting through a stack of fresh reports. We've got Bloomberg, CNBC, Reuters, and Yahoo Finance all published just this week.
That's right. Our mission is pretty simple. Extract the most crucial nuggets of knowledge, those key insights for you.
Exactly. We want to provide a shortcut, really, to understanding the powerful forces shaping global markets, tech, and policy.
Everything from central bank moves to, well, the latest in global trade and technology.
It's all connected.
Okay, let's unpack this then. We're going to dive into why global equities are soaring right now.
And the intricate, surprisingly dramatic situation unfolding at the U.S. Federal Reserve.
Yeah, that Fed story is something else. Also, the paradoxical successes and complex challenges facing major tech giants.
And, of course, those ever-present geopolitical currents impacting economies worldwide. It's shaping up to be a busy, pretty fascinating week.
Definitely. So let's jump right in.
The sheer breadth of these stories is quite remarkable. And what's truly insightful is how deeply they intertwine, isn't it?
Absolutely. We're not just looking at isolated incidents here.
No, not at all. We're observing a complex, interconnected ecosystem where, one action can ripple across multiple sectors and regions.
Right. And speaking of complexity, let's start with what many sources, like Reuters and Bloomberg, are calling the biggest story of the week.
The U.S. Federal Reserve's policy meeting kicked off this very week.
And markets are absolutely buzzing with expectations. From what we've seen in the reports, there's a lot more than just pure economic data driving the conversation. Right?
Oh, definitely. A key takeaway from reporting by Reuters and Bloomberg is the strong consensus around an impending rate cut.
Okay.
SWOX markets, they're fully pricing in a 25 basis point reduction. That's a quarter of a percentage point.
And that would be the first cut since December last year.
Correct. And it's not just one cut they're thinking about. Bloomberg's survey of Bank of America fund managers, BOFA, it reveals nearly half expect 4 or even more rate cuts in the next 12 months.
Wow, 4 or more.
Yeah. And this comes amidst, a weakening labor market. We saw the unemployment rate rise to 4.3% in August.
But inflation's still sticky, right? Still above that 2% target.
It is, still drifting above the Fed's target, partly due to existing tariffs. So it creates this deeply fractured economic picture.
Forcing the Fed to prioritize either growth or price stability.
In a way we haven't seen in years, really. They're in a tough spot.
And beyond the economic data, it sounds like there's an incredible amount of political intrigue swirling around this Fed meeting. Can you unpack what CNBC and Reuters are revealing about this as, unprecedented drama and how it might be impacting the Fed's independence?
Yeah, it's quite something. This isn't just a procedural hiccup. It raises profound questions about the very bedrock of the Fed's independence.
How's it?
Well, President Trump has been openly pushing for deeper rate cuts, using platforms like Truth Social to demand Chairman Powell cut rates now and bigger than he had in mind. That's a direct quote.
That's very direct.
Very. And adding to this, his administration attempted to remove Fed Governor Lisa Cook for cause.
Right, citing those mortgage fraud allegations, which she denies.
Vehemently denies them. Fortunately, a federal appeals court blocked that move, so Cook can attend this week's critical meeting.
Okay, but that wasn't the only thing happening.
No. Simultaneously, Stephen Murin, President Trump's pick and a former White House economic advisor, was narrowly confirmed to an open seat on the Fed board.
Narrowly, like 48-47, according to CNBC and Yahoo Finance.
Exactly. And he'll participate in this week's meeting, even while just taking a leave of absence from his White House role, not resigning outright.
So critics are concerned about potential influence from the executive branch.
Absolutely. On what should be an impartial, data-driven body. It really highlights the challenging tightrope walk the Fed is currently performing.
That's quite a political minefield for them to navigate. But, okay, for investors looking at the bond markets right now, how are they reacting?
Well, if we connect this to the bigger picture, bond investors, as Reuters highlighted, are already being proactive.
How? Buying longer-term debt.
Yes, buying longer-term maturities, up to 10-year debt. They're anticipating these rate cuts will make those longer-dated bonds more attractive.
And that's playing out in returns.
It seems so. U.S. Treasuries have actually outperformed global bonds this year, returning 5.8%, according to Bloomberg.
So the prospect of Fed easing is outweighing worries about U.S. fiscal deficits, for now at least.
For these investors, yes. We're also seeing investors piling into steepeners. That's basically a bet on a steeper yield curve.
Meaning short-term yields fall with the cuts, but long-term yields stay pressured by inflation or deficits.
Precisely. And it's not just bonds. Yahoo Finance reports that gold has hit new records, surpassing $3,700 an ounce.
Clearly buoyed by those rate cut bets and a weaker dollar.
Definitely shows a clear confidence or perhaps anticipation of the Fed's eventual easing, despite all the political noise.
Okay, so while the Fed navigates its tightrope, global stock markets are just soaring.
Scaling new heights. We're talking bulls galore, as Bank of America's Michael Hartnett put it in Bloomberg.
The S&P 500 closed above 6,600 for the first time. Japan's Nikkei 225 broke 45,000. That's according to CNBC.
Yeah, this surging sentiment is fueled by, well, robust economic growth expectations and a renewed, almost feverish enthusiasm for artificial intelligence, AI.
Right. Bloomberg's survey showed a net 28% of global fund managers are overweight equities, highest in 7 months.
And fewer investors now expect the economy to weaken. Robust corporate earnings, the perceived impact of AI, it's all underpinning this optimism.
And about half of those Buffett survey participants believe AI is already increasing productivity.
According to the Bloomberg report, yes, reinforcing that narrative that AI is a significant tailwind for growth.
But here's a really intriguing twist from CNBC. Google's parent company, Alphabet, just joined the exclusive $3 trillion valuation club, alongside Apple, Microsoft, and NVIDIA.
Big milestone.
Huge. But the fascinating part, according to CNBC, is that this bump isn't primarily because Google's AI offerings are blowing investors away.
Oh, what's the reason then?
It's partly because Google has been perceived as falling behind AI rivals, like OpenAI and Perplexity.
Falling behind helps its valuation. How does that work?
Well, that perception actually allowed it to escape divesting its Chrome browser in a recent antitrust ruling.
So avoiding a major regulatory headache boosted the stock.
Kind of a reverse psychology win, isn't it?
That's a profound insight into market dynamics, really, this Google paradox. It reveals a fascinating truth about market valuation in heavily regulated sectors.
That's sometimes strategic underperformance or perceived underperformance.
Right. If it helps you sidestep regulatory scrutiny, it can paradoxically fuel growth elsewhere. It proves avoiding those headaches and maintaining core assets can be as valuable as direct innovation, at least in the short term.
Interesting. And speaking of AI competition, CNBC also reported OpenAI just hired Mike Liberatore
xAI's former CFO, right?
to manage its massive infrastructure spending. Marks the latest move in that escalating rivalry between Sam Altman and Elon Musk.
That feud has been simmering for a while now.
Meanwhile, NVIDIA, a major AI player we talk about a lot, facing some headwinds, especially in China.
Reuters reported on this. Their new RTX 6000D chip, the one designed specifically for China to comply with U.S. export restrictions.
It's seeing lukewarm demand.
Yeah, apparently. Chinese tech giants reportedly find it expensive for the performance it offers.
And they're still waiting for clarity on older chip orders, or hoping for more powerful options.
Seems like it. It really highlights the significant impact of U.S.-Sino trade tensions on the tech sector.
And Reuters noted Beijing has even accused NVIDIA of violating anti-monopoly law.
Yes, further complicating its business in China. And at the same time, China is actively encouraging domestic chip alternatives.
A clear strategic move to bolster their own tech independence.
And reduce reliance on foreign suppliers. It's a direct consequence of this geopolitical chess match playing out in technology.
Okay, so while tech giants grapple with these trade tensions, let's broaden our lens to that geopolitical landscape itself.
Where these economic forces are playing out directly.
Exactly. U.S.-China trade negotiations, for instance.
Yeah.
Back in the spotlight in Madrid, President Trump noted some progress.
Especially on a framework deal for TikTok's divestment, apparently.
But overall, trade tensions are still very much alive, wouldn't you say?
Oh, absolutely.
Yeah.
While the offshore yuan, the Chinese currency, has gained about 3% against the U.S. dollar this year.
Which is mostly due to a weaker dollar overall.
Primarily, yes. But it has significantly weakened against other major currencies, the euro, the pound, the yen. That's according to CNBC.
And that divergence makes Chinese exports more competitive in non-U.S. markets.
Right, which stokes concerns about trade imbalances with other partners like India and Mexico.
And Goldman Sachs economists, cited by CNBC, suggested the People's Bank of China's unusual appreciation bias in its daily fixing
could be seen as a kind of goodwill gesture amid the trade talks. Especially since a weaker dollar is one of Trump's economic priorities. It's a very careful dance.
Managing domestic goals and international relations. Okay. And speaking of international relations, President Trump's state visit to the UK this week. Beyond the usual pomp and pageantry, CNBC reports this visit comes at a crucial time for the UK economy and Prime Minister Keir Starmer.
Who desperately needs some positive news amidst all the domestic political turmoil.
So what kind of economic impacts are we seeing tied to this visit?
Well, there's some good news. Google announced a $5 billion investment in UK AI. That includes a new data center, funding for DeepMind. CNBC reported that it's a significant boost.
But there's pressure, too, from pharma companies.
Indeed. Companies like AstraZeneca and Merck have paused UK investments. They're urging better support and drug pricing.
And this urgency is heightened because of a Trump administration deadline.
Exactly. A deadline for them to lower U.S. drug prices to levels paid by other advanced nations. This reflects a broader trend, also highlighted by CNBC, of pharma firms potentially redirecting capital towards the more lucrative and predictable U.S. market.
Interesting. Shifting back to domestic U.S. concerns, the ripple effects of international policies aren't just felt overseas.
No, definitely not.
Closer to home, the Trump administration is grappling with the fallout from that immigration raid at the Hyundai LG battery plant in Georgia.
Right, where hundreds of South Korean workers were arrested. CNBC reported that this has sparked concerns about foreign investment,
leading the administration to express regret and discuss new visa programs to try and smooth things over.
Yes, but incidents like this can definitely have a chilling effect on international businesses looking to invest here.
It really showcases that complex interplay between immigration policy and economic development.
It creates uncertainty, which can deter that crucial foreign direct investment needed for job creation and economic growth.
And just quickly on a different note, India. Despite floods, CNBC analysts seem optimistic about inflation.
Yeah, they expect it to remain in check for fiscal year 2026, staying below the central bank's target.
Leaving room for more rate cuts there to spur domestic growth?
Even amidst their own trade worries with the U.S., it's an interesting contrast to the inflation battles we're seeing elsewhere.
Okay, moving to corporate news. President Trump has reignited that debate about earnings reports.
Ah, yes. Pushing for U.S. companies to switch from quarterly to semi-annual reporting.
As Bloomberg and CNBC noted, he argues it would save money and allow managers to focus on properly running their companies. Sounds straightforward. But what's Wall Street's actual take?
Well, this raises an important question, and opinions are quite divided, according to Bloomberg.
Some analysts think it might happen.
Some do. Like TD Cowen's Jarrett Seiberg, who sees a 60% chance the SEC might implement this, cites a potential easy policy win given the SEC chair's deregulatory focus.
But others are raising alarms.
Big alarms. Concerns about increased uncertainty, greater market volatility due to less frequent information, and reduced accountability for companies.
They value the transparency of quarterly calls.
Many do. They value that dialogue with investors. It's a real tug of war between cutting administrative costs and maintaining market transparency.
Got it. In other big corporate news, Elon Musk. A huge vote of confidence in Tesla.
Purchasing $1 billion worth of shares, according to Yahoo Finance. First time he's bought stock on the open market since 2020.
And that immediately erased Tesla's year-to-date losses, pushing it positive.
It did. What message does a significant purchase like that send? Especially for a company with such ambitious plans for autonomous driving and humanoid robots?
It definitely sends a strong signal to the market, right?
Okay.
Especially after the stock faced headwinds earlier this year.
Absolutely. It underscores the immense influence individual leaders can have on market sentiment. When a CEO, particularly one as prominent as Musk, makes such a substantial personal investment.
It's seen as an unequivocal endorsement.
Of the company's long-term vision and financial health, yeah, it can entirely shift investor perception and inject renewed confidence.
Okay, and finally, the Trump administration ordering Delta and Aeromexico to unwind their joint venture.
Their nearly decade-old partnership, yeah. By January 1st, according to CNBC.
Citing anti-competitive effects in the U.S.-Mexico City market.
Both airlines expressed deep disappointment. They argued the partnership generated significant economic benefits.
So what are the practical implications here?
Well, this decision highlights that complex intersection of antitrust regulation and international business partnerships. The administration's move suggests a focus on consumer choice, competitive pricing on a key route.
But the airlines argue unwinding it causes harm.
They do. They mention $310 million generated for the U.S. economy, potential harm to jobs and consumers. It shows how regulatory intervention, even if intended to promote competition, can have significant ripple effects on routes, fares, the whole travel ecosystem.
For business and leisure travelers alike.
Def-
So wrapping this all up, what does this mean for you listening in? We've covered a vast landscape today.
From the delicate balance of central bank decisions to surprising shifts in tech, global trade, corporate strategy.
It's clear the global financial stage is incredibly dynamic. Policy, innovation, geopolitics, all playing crucial, interconnected roles.
What's fascinating here is how these seemingly disparate stories, a Fed rate cut, a tech giant's regulatory escape, a change in trade policy, they aren't just individual headlines.
They're all threads in a larger tapestry.
Exactly, each influencing the next. This raises an important question for you to consider. As global central banks grapple with inflation, political pressure, the push for growth, and as trade tensions reshape corporate strategies, what are the subtle cascading effects these shifts might have on your own financial planning and investment decisions in the coming year?
A lot to chew on, definitely, and plenty of reasons to stay informed about these dynamic forces. We hope this deep dive into the headlines from Bloomberg, CNBC, Reuters, and Yahoo Finance has given you a clearer picture of the financial world's pulse.
We hope so too. It's a constantly evolving picture.
It really is. We'll see you all tomorrow morning with new headlines from major financial magazines.